So a lot of people are agreeing that the stock market's going to crash. Like the US dollar, there's no real timescales being put on this, and it may well happen at the same time. The one may very well precipitate the other. Now let's have a look at why the stock market is likely to crash. And the first thing, which is quite easy to understand, is unemployment. Now the government is claiming one thing, other people are claiming another. So let's have a look. This is shadowstats.com, and they track different unemployment measures. Now the thing is that in 1994 the government decided that people who were long-term unemployed and short-term discouraged workers and all the rest of it would no longer be counted. Wonderful. Okay, so if we have a look at the red line down here, this is the official government estimate of unemployment, and they think, oh, it shot up to 10% in 2010, but now things are much better, the economy is recovering. Look. Okay, now there's a problem with this, and that is really, to get the true figure you have to add in the people that they took off. All these people who cannot find jobs, basically. They're not people who don't want to work. They're people who, for no fault of their own mostly, have ended up on food stamps, they've ended up on various support programs, and they're no longer counted because the government thinks they're not looking for work, when the truth is they are damn well looking for work, they just cannot find a job. So if we look at those figures, which is this top blue line, we can see that there is no recovery. In fact, things are steadily getting slightly worse, and the true unemployment rate is around 23%. That's nearly a quarter of all the people in America who could work don't have a job. You just think about that, and think of how many people you know who don't have a job. Now this has an effect on other things, and this is why the government fiddles this number. The main thing it has an effect on is GDP. Now if we look at GDP, you'll see that the government has trumpeted various figures. Here's the official, this is the red for unreliable, and you can see it pretty closely tracks until you get down here, 1994, when the employment figures start diverging away from what the government has actually done. Now you can see here you've got the 2008 crash. Horrible, horrible, horrible. No growth in GDP. In fact, it's minus 4% according to the official figures, but minus 6% according to the reality, if you take into account the unemployment figures. And they say, oh yes, it's going positive, and you can see there's this trend line going upwards, and it might hit 4% in like 2018 if you're lucky. But in actual fact, it's still contracting. The economy is still contracting. Now you say, well, if you look at stock market, how can this be? Because here you've got the NASDAQ figures over the last year, and you can see the stock market is climbing, it's climbing, it's climbing, it's getting to new heights. Yeah. But also, if you look at the volume of trade at the bottom, you can see that the volume of trade is only high when there's a drop, and it's low when it climbs. And this means really that people don't have any faith really in the stock market, the people who know what they're doing. And it's an indicator that has been seen before. This really big rise in stocks, accompanied by a decrease in volume, has been seen before during the Great Depression. But how come stock prices are so high? And especially the stock prices of major companies who, to be honest, their profits have contracted and they're not making so much. And here's the answer. The companies that are doing the best on the stock market are buying their own shares. And you can see the analysis here. Companies are buying their own shares at the briskest clip since the financial crisis, helping to fuel a stock rally amidst a broad trading slowdown. And corporations brought back $338.3 billion worth of stock in the first half of the year. Now, here's the big repurchases, but you add those up, it doesn't come to anything near 338.3 billion. And the reason for this is there's lots of smaller companies, including companies that don't really produce anything, who are buying their own stock back. And how are they doing this? They're doing this by going into debt. Because the interest rate is so low, it actually pays them. And this is the insane bit. Because these shares have dividends, it actually pays them, on paper, to purchase their own shares and take the dividends from those shares, pay it to themselves, and guess what? That is more than the interest on the money that they're borrowing. So if you look at the top names here, you've got Apple. Everyone knows Apple's been doing really well recently. Well, it's no wonder they're buying 32.9 billion of their own shares, helping to keep the price inflated. The same with IBM. IBM, their trading has contracted all the way. Their profits gone down by quite a lot. But their share price has gone up. Why? Because they spent 19.5 billion this year on buying it back. And the list goes on. Even banks are doing it. Goldman Sachs, well, what do you mean even banks? They actually get the money cheaper than the rest, I expect. And here we go. The growth in buybacks comes as overall stock market volume has slumped. Not so many people are trading. I wonder why. Going out buying gold, I suspect. Companies with the largest buyback programs have outperformed the broader market by 20%. And so this particular article goes on, and this comes from WSJ.com, Wall Street Journal. So let's look at one of these companies. Let's have a quick look at IBM. And as this article points out, the number of shares bought back by IBM have reduced the share count. And this is one of the ways that companies manipulate their share price higher. Because if there's fewer shares, people find it more difficult to buy them, so they've got to pay more for them. So they start making more on the shares. And then IBM, doubtless, will possibly share a few, release a few shares at a stonking profit. And let's go down. I think there's some more data somewhere. Yep. The repurchases, meanwhile, have taken a toll on IBM's balance sheet. total debt climbed to 44 billion. This is because they're borrowing money to buy their own stock back. Now, this in reality is nuts, because all the money that they spend on buying their own stock back, they're not spending on plant, they're not spending on new designs, they're just spending it on fiddling around with their financial data. Now, why are they doing this? The answer is because of the level of unemployment, because of the low GDP, they can't actually sell anything. So the only way that they can make money is through financial manipulation. So this is exactly what they're doing. And this is what is going to fuel the collapse of the stock market. Because you have all these thousands of companies on there, an awful lot of them doing buybacks, an awful lot of them adding debt, rather than adding new capital goods, rather than adding new machinery, rather than adding new designs to their portfolio, new products, rather than investing in innovation as the Chinese have. This is what they're doing. They're tiddling around with finance, and as soon as something happens, just a slight waver in the interest rates or a slight problem with the US dollar, all of these companies are going to be in desperate trouble, and it's all going to be at the same time because they're all in the same boat. And really, I would say to you, I mean, I lost my pension fund because it was invested in stocks and shares and all these wonderful derivatives during the 2008 crisis. So I know what it's like to lose all of your money and all of your pension money. It just evaporates into thin air. There is nothing you can do about it. If you have an opportunity, if I were you, I would get that money now and I would buy physical metals, as every other country is doing. If you look around at the moment, you've got Holland that's repatriated gold, Germany that's trying to, but the United States won't let it, and you've got France that's talking about it. You've got Switzerland that have a vote literally tomorrow on whether to repatriate their gold and actually back their currency with more gold. So why are these countries doing this? They're doing this because they know that the entire financial system, including the stock market, is going to go down the toilet. This is all the indications. You've got Warren Buffett, who's buying things like railroads, which have enormous amounts of physical assets. All the indicators are that everyone, everywhere, thinks that the whole world financial system is going to go down the toilet. Now, I've got to add a bit of a disclaimer here. I've had a bad experience. As I said, I lost my pension. So maybe I'm a bit biased, but if I'm biased, everyone else has to be as well. Don't take my word for it. Do your own research, make your own mind up, look around, see what's going on, and then have a think. Well, I hope this has been of some help to you and that you found it interesting, and if you have, please like, please share, please subscribe. Thank you very much.
After hour, the market continued its descent into chaos and pandemonium as stock prices simply collapsed under the torrent of panic sales. And desperate brokers fought and screamed and trampled one another to get out.
16 million shares traded that day, which seems like nothing today because we trade 16 million shares in the first 5 seconds of the business day. But the trading record set on the day of the crash, the 16 million shares, was not vested until 1969. It was 40 years before the New York Stock Exchange traded more shares than it traded on the day of the crash. The tickers did not stop running until 7:45, when the market had closed at 3:30, I guess.
In the worst single day in the history of the New York Stock Exchange, the market lost $14 billion in value, bringing the week's loss to more than $30 billion, 10 times more than the entire annual budget of the federal government, and far more than the United States had spent during all of World War I. Worst hit in the short run were the thousands of small investors who, believing that everyone could be rich, had bought stock on margin, sometimes borrowing as much as 90% of its book value. In a matter of hours, in